A man in North Carolina withdrew $94,000 from his retirement savings last year, enough to live on, travel, help his kids, pay every bill he had. His federal tax bill on that money was zero, not a small number, not a rounding error. $0 on $94,000 in withdrawals, filed and accepted by the IRS. His accountant called him to make sure he understood what had just happened, because it was going to keep happening for at least 7 more years. Nothing about this was luck. Nothing about it was a loophole for the wealthy. It started 11 years earlier on a Saturday morning with one decision almost nobody else in his position ever makes. Here is exactly what he did and why the window to do it yourself is still open right now.
Right now, sitting inside the enormous, complicated IRS tax code, there is a hidden yet entirely legal tax strategy. It literally has your name on it, and yet the overwhelming majority of American retirees are never going to use it. It's not because it's restricted or only for the ultra-rich. It's definitely not because it's too complex. It's simply because nobody ever sat down with them, looked them in the eye, and explained how it works in plain, everyday English before it was too late. Well, this explainer is going to be that plain English translation for you. Make absolutely no mistake about this. What we're exploring today is not a loophole. It's not some shady gray area, and it's certainly not a trick reserved for wealthy people with expensive offshore accounts. Actually, it's a thoroughly documented method perfectly designed for the American middle class. It's really just about understanding the rules of the game well enough to legally and permanently eliminate an enormous financial burden from your golden years. I want you to picture a very specific Saturday morning. We're not in a stuffy financial seminar, and we're not in a towering glass brokerage office in Manhattan. We're on a screened-in porch in the back of a modest house in Asheville, North Carolina, September of 2026. The man sitting in the wooden rocking chair, holding a cup of black coffee and taking in a sweeping view of the Blue Ridge Mountains, is Thomas. He's 68 years old. He retired 3 years ago after a long 33-year career as a high school history teacher and school district administrator. He and his wife, Carol, live in a home they completely paid off at age 61. They travel, they help out their 2 adult kids. Thomas doesn't exactly look like a guy who figured out a massive, life-changing financial secret. But he did.
Last April, Thomas filed his federal income tax return for 2025. Over the course of the year, he withdrew $94,000 from his retirement accounts to live his life, travel with Carol, and pay all the bills. But his federal income tax liability on that $94,000 was exactly $0. Not a few $100, not close to zero, literally zero. His accountant actually called him when the return was finalized just to make sure he grasped what had happened, but Thomas already knew. He'd been planning for this precise outcome for 11 years.
Thomas achieved this incredible feat through a highly predictable, repeatable strategy. It's called the Roth conversion ladder. Basically, this is a multi-year strategy where you systematically move traditional pre-tax retirement funds over into completely tax-free Roth accounts. The magic here is that you do this at controlled tax rates that you personally choose, rather than at unknown, likely higher rates forced on you by the government later in life.
Let's unpack Thomas's starting financial picture when he officially retired at 65. First off, he had a state teacher's pension paying him $33,600 a year. He also had $68,000 sitting in a brokerage account, which generated about $1,800 in dividends. And then there was his future Social Security, projected at $2,140 a month. Now, those sources were largely out of his control when it came to taxes, but he also had a traditional IRA sitting at $310,000, which would be fully taxable upon withdrawal, alongside a Roth IRA of $287,000, which would be completely tax-free.
Now, that massive Roth IRA balance didn't just happen by accident. Starting at age 57, giving himself a solid 8-year runway before his retirement at 65, Thomas went to work. During those final 8 working years, he carefully looked at his total taxable income from his teaching salary and other sources. Then, he calculated exactly how much room he had left in the lower federal tax brackets. Every single year, he converted just enough money from his traditional IRA into his Roth IRA to perfectly fill up that lower bracket without ever spilling over into a higher tax penalty.
The math on this is just brilliant in its simplicity. By converting an average of $24,000 a year for 8 years, Thomas moved a total of $192,000 completely out of his taxable traditional IRA. Because he was so careful about managing these conversions, he paid an effective tax rate of just 15% on that money. So his total tax cost over those entire 8 years was a very manageable $28,800.
In exchange for paying that $28,000 up front, Thomas essentially built a massive tax-free fortress.
Thanks to 8 years of steady market growth, that converted money blossomed into an incredible $287,000 Roth IRA by the time he hit 65. Every single dollar inside that account is now permanently tax-free, and this is crucial. Withdrawals from this specific account completely bypass the provisional income formulas that make your Social Security taxable. They bypass the Medicare premium surcharges, and they are completely immune to those dreaded required minimum distributions.
So how exactly did this translate into a zero tax return in 2025? If we map out his actual gross taxable income for that year, we see his pension at $33,600, his $1,800 in dividends, and, because he expertly kept his other income low, only $18,100 of his Social Security was actually taxable. That brings his total taxable income to $53,500. Now, you're probably wondering, wait, where's the rest of the $94,000 he spent to live his life? Well, he withdrew roughly $33,000 from his Roth IRA. But to the IRS, that money is completely invisible. It literally doesn't even exist on their radar.
Next, we apply the standard deductions. Both Thomas and his wife are over 65. In 2026, the standard deduction for a married couple over 65 is roughly $33,200. When we subtract that massive standard deduction from his $53,500 of taxable income, Thomas is left with a remaining taxable income of just over $20,000. At this point, the federal income tax on that remaining $20,000 sits securely in the lowest 10% bracket. That leaves him with a tiny liability of $2,030. But Thomas had one final ace up his sleeve. He carried forward a small $2,100 solar panel tax credit from an installation he did back in 2022. Since tax credits reduce your liability dollar for dollar, that single credit entirely wiped out the remaining $2,000. The final result? A federal tax bill of absolute zero. Now, as incredible as all of this sounds, we do need to take a quick reality check here. This isn't magic, it's pure mathematics. Thomas's success relied on a few very specific yet incredibly common real-world conditions. If you're sitting at home right now wondering, can I actually pull this off? You really need to understand the environment that made this possible for him.
The very first condition is time. The Roth conversion ladder is completely fueled by time. You need a meaningful traditional IRA balance and the years to actually execute the moves. An 8 to 10-year window before retirement is really the sweet spot. Think about it. If you only have a 2-year runway, converting $24,000 a year yields $48,000 in Roth assets. That's helpful for sure, but it's not exactly life-changing. But with a 10-year runway, those exact same conversions can produce a $350,000 to $400,000 tax-free shield. The earlier you start, the more exponentially powerful the outcome. The second condition is having a moderate income. This strategy is tailor-made for the American middle class. Your target taxable income in retirement really needs to sit somewhere between $30,000 and $55,000 before deductions. Why? Because you need the standard deduction to absorb the vast majority of it. Honestly, this strategy falls apart for retirees who have massive corporate pensions, and it completely fails for folks sitting on massive, unmanaged traditional IRAs that will eventually force huge taxable required minimum distributions on them, whether they need the money or not. Finally, we have the philosophical foundation of all this, the tax rate bet. Thomas was entirely willing to pay a known, highly controlled 15% tax rate today to completely avoid an unknown and potentially much higher tax rate tomorrow. He bet that having a massive tax-free income source in his retirement was well worth paying a small toll up front. Sitting on his porch today with a $0 tax bill, he knows for a fact he won that bet. To truly grasp how valuable this is, we have to look at the devastating cost of inaction. Enter Richard. Richard was a former colleague of Thomas. They retired from the exact same school district within 2 years of each other. They had the exact same pension, and at age 57, they had the exact same $300,000 balance in their traditional IRAs. But Richard did absolutely nothing. He'd never even heard of the conversion ladder, so he just left his IRA entirely untouched. Because Richard did nothing, his traditional IRA quietly grew to $490,000 by the time he retired. Sounds great, right? Wrong. It was a ticking tax time bomb. At age 73, the IRS forced Richard to start taking required minimum distributions, or RMDs. His forced distribution is over $18,000 a year. This forced income instantly pushed his provisional income so high that a staggering 85% of his Social Security suddenly became taxable.
Let's compare the financial destinies of these two men.
Over 20 years of retirement, Richard's forced withdrawals and triggered taxes mean he's going to pay somewhere between $116,000 and $144,000 in lifetime federal taxes. Thomas, who proactively managed his taxes over that 8-year runway, paid a grand total of $28,800. By simply understanding the tax code and taking decisive action, Thomas saved well over $100,000 compared to his colleague.
So the single most pressing question for you right now, whether you're 45, 55, or 75, is this. Is your window still open? Are you sitting on an untouched traditional IRA or a 401k that is slowly but surely building toward a massive, forced tax burden in your 70s? If you are more than 3 years away from retirement, I can promise you, a version of this strategy is absolutely available to you today.
You just have to find your own conversion space. If you're married and filing jointly in 2026, the 12% tax bracket extends all the way up to roughly $96,950 of taxable income. You need to calculate the gap between your current taxable income and that ceiling. That gap is your sandbox. That is the exact amount of money you can safely move from your traditional IRA to your Roth IRA every single year at a highly favorable tax rate. Take your time, sit down, and measure that gap carefully.
If you realize you're in this window, your next steps are absolutely critical. First, log into your accounts this week and write down the exact split between your traditional pre-tax balances and your Roth balances. Second, pull out your last tax return and calculate that gap to the top of the 12 or 22% bracket. Third, and honestly most importantly, call a CPA or a fee-only financial planner this month and specifically ask for a multi-year Roth conversion analysis. It might cost you a few $100s up front, but as we just saw, it could save you hundreds of thousands down the road.
Actually, before you even make that call, pause this explainer for a second and join the conversation down below. Let us know your age and what state you're in. What does your traditional versus Roth split look like right now? Have you ever actually had a professional sit down and talk to you about a Roth conversion? Sharing your situation really helps push this critical middle-class tax education out to others who desperately need to see it. And make sure to subscribe so you don't miss the real-world strategies that the traditional financial industry often ignores. Thomas is still out there on that porch in Asheville. The coffee is still warm. You know, he wasn't lucky and he certainly wasn't uniquely wealthy. He just started 11 years before he actually needed to. He converted a specific measured amount every single year, paying a tax rate he controlled so he would never be forced to pay a rate he didn't. That porch cost him nothing to sit on. The mountain view cost nothing to look at. His $0 tax return simply cost him a little bit of patience and planning. You're thinking about your own situation right now, and that is exactly 11 years earlier than never. So what is your retirement going to look like when the IRS finally comes knocking?
Thomas never got rich overnight. He never found a secret. What he found was a question, asked 11 years too early to feel urgent and 11 years early enough to matter. Every dollar he moved from that traditional IRA to the Roth was a small act of faith in a version of himself that didn't exist yet. The version sitting on a porch in Asheville, coffee in hand, owing nothing. He paid for that man in installments, a little bit each April, back when it was easy to ignore. That's the real lesson here. Not the tax code, not the brackets or the thresholds. It's that the most expensive financial mistakes rarely announce themselves. They just sit quietly for a decade, waiting to become permanent, and the most valuable decisions look, in the moment, almost too small to matter. Richard didn't do anything wrong. He just never got asked the question. That's the whole difference between his story and Thomas's. Not intelligence, not luck, just 11 years, and someone willing to ask it out loud. Somebody just asked you. If stories like this, the quiet decisions that end up changing everything, are the kind of thing you want more of, this channel is where you'll find them.